In this presentation, I'll talk about the relative strength strategy. The objective of this strategy is to outperform the broader market by rotating capital into the strongest performing sectors and assets based on momentum and relative strength. The core principle here is strength begets strength, where assets demonstrating superior recent performance are more likely to continue outperforming in the short to intermediate term. And that is depicted in this graphic here. You've got two assets, each one with different rolling performance, and this is where you do the switch. This particular strategy has plenty of empirical backing where it's been supported by academic and practitioner research over the decades. It also captures a behavioral edge. It captures persistent investor behaviors such as herding, underreaction, and trend following. And inherent to this strategy is an adaptive allocation. It rotates into leadership areas during different economic and market cycles. For example, in economic booms, it might be invested in technology-heavy mutual funds or ETFs, whereas in times of uncertainty, it might be invested in gold or precious metal mining-related mutual funds and ETFs. And in times of economic downturns, it might be invested in inverse exposure ETFs. And importantly, it does all of this without the need for economic forecasting or prediction. It does all this simply by looking at momentum measurements on a relative basis amongst all the different asset classes. Methodology. The ranking mechanism is one where the funds are ranked using an intermediate term rate of change, which is approximately a 1-year look back. The rebalancing frequency is monthly. And for the positioning rules and risk management, these are the rules. Every month, the top 3 ranked assets are selected and equally weighted. And we limit those funds to only those that are in an uptrend. And for risk management, if the broad market, which is the S&P 500, is in a downtrend, we reduce exposures across all holdings to 50%. Portfolio characteristics. This strategy has an extremely diverse exposure. It has a universe of more than 50 asset categories and more than 150 funds. And it spans equities, bonds, commodities, international markets, real estate, and inverse equity index. In the first column, we see we have the equity exposures. We have all the different sectors and investment styles represented here, ranging from communications to consumer cyclical to healthcare to large cap blend, mid caps, small caps, tech and utilities. The second column is bonds. Here we also have a huge assortment of fixed income instruments represented. Everything ranging from bank loans to convertibles to corporates, emerging markets, emerging market bonds, high yield or junk bonds, government bonds of different durations, muni bonds, and as well as some short-term instruments. In the commodities, we have metals, energies, precious metals, and other natural resources. In the international equities, we have broad-based representation of global regions such as Asia Pacific, Europe, emerging markets, etc. And in the real estate, we have global real estate and US real estate. Expected performance. Here we've back-tested the strategy going from 1991 to April 2025. And we see that the relative strength strategy's annualized expected rate of return is 17.1%. The benchmark S&P 500's rate of return over that same time frame is just 8.7. The maximum expected drawdown of the strategy over that time frame is negative 27.9, whereas the S&P has had a negative 57% peak to valley drawdown. The Sharpe ratio of the strategy is about 1, whereas the S&P 500 is about 0.5. and the correlation of returns of the strategy to the S&P 500 is about 0.47. And if you look at the returns of the strategy compared to the benchmark S&P on a year-by-year basis, we can see that during, first of all, the dot-com bubble years, the S&P 500 was down 3 consecutive years, negative 10%, negative 13, negative 23, whereas the strategy would have been up 23%, negative 2% in 2001, and in 2002 it was up 13% when the S&P was down 23. In the subprime crisis of 2008, the S&P 500 was down 38%, whereas the strategy was down 4%. And more recently, in 2022, when the S&P 500 was down 19%, the strategy was up 10%. And so far, year to date, up to the end of April, when the S&P 500 was down 5%, the strategy is up 11%. And here's the equity curve of the strategy compared to the benchmark S&P 500. Green line is the strategy. We can see that it's a lot more linear, higher in magnitude, and lower in volatility than the benchmark. How do we implement it? The monthly model allocations are emailed to subscribers on the last night of every month. And the trades are placed the next day to match the portfolio allocations. And the whole process has been designed with ease of implementation in mind. One should expect to spend about 10 minutes each month to enter and exit positions. And here's a sample signal that will be emailed out. This one says FSAGX, Fidelity Select Gold Portfolio, FSRBX, Fidelity Select Banking Portfolio, and GLD, which is the gold ETF. And each of those has equal allocation, 33%, a third each. So in summary, the strategy is able to overcome buy and hold bias by actively shifting to higher momentum sectors and assets. And by doing so, it outperforms the S&P 500 with a much lower drawdown. It is a tactical strategy where it adapts to changing macroeconomic and market environments with a rules-based discipline. The strategy requires minimal time investment, only about 10 minutes a month to reposition the portfolio. If you want to get more information on the strategy and you want to sign up for the signals, please visit my website at this URL here. It's also pasted in the description box below. So that concludes my presentation for today. Thank you for watching.